Hi everyone, I'm Victor, analyst for Baybannfa International. Welcome to the monthly foreign exchange analysis, bringing you the eye on the forecast for April 2022. The first forecast we got Euro-US dollar currency pair. The Euro-US dollar pair hovers around the 1.100 mark, unable to attract speculative interest throughout the week. Volatility has been limited, partially due to the scare macroeconomic calendar, but also amid increasing uncertainty over the war. Russia escalated its attacks on neighbor Ukraine, while a diplomatic solution is slipping further away. Occidental leaders keep piling up sanctions on Moscow. NATO announced it would enhance its presence of troops in the eastern and southeastern parts of its territory, with soldiers from the US, Canada, Germany, and the UK. The American dollar appreciated on Monday as U.S. Federal Reserve Chair Jerome Powell became even more aggressive. Speaking about the economic outlook at the National Association for Business Economic Annual Economic Policy Conference, he said inflation is much too high and that the central bank will respond accordingly. Powell joined the 50 BPS high club, as several Fed members have noted they would support such a move as soon as May. He noted that their plans to reduce the balance sheet would likely be completed by the next meeting, although he did not clarify when they would start shrinking it. The Euro-US dollar pair is bearish according to the weekly chart, as it shows that the price remains far below all of the moving averages. The 20 SMA has firmly lower, now a handful of pips above the 61.8% retracement of this year's slide. Technical indicators in the meantime remained directionless within the negative levels. The 23.6% retracement of the same rally provided weekly support in the 1.0960 price zone, the main area for bears to beat. Once below the latter, the pair could retest the year's low at 1.0805. The daily chart shows that the bearish 20 SMA, which rejected bulls throughout the week, is now maintaining its downward slope at around 1.1015. The momentum indicator advances within positive levels, diverging from the RSI indicator, which is heading lower at around 43. Bulls may have better chances in the pair recover beyond 1.1070, the 38.2% retracement of the aforementioned decline, with room then to extend gains toward the 1.1150 price zone. According to the forecast poll, the US dollar-euro pair will remain under pressure in the near term, but could recover some ground afterwards. Bears stand for 50% of the polled experts in the nearest progressive, with an average target of 1.0979. Bulls are the majority of 58% in the monthly view, aiming to reach the 1.1100 price zone. Finally, the quarterly view suggests the pair will remain with the 1.09-1.11 price zone, with bulls barely overcoming bears. The overview chart indicates the bears hold the grip. The three moving averages under the study head lower with uneven strength. More relatively, the same chart shows the number of those betting for possible targets sub 1.1000 continues to increase, and the pair has the chance of reaching fresh 2022 lows. Next pair we got is Great Britain Pound US Dollar weekly forecast. Correction set to extend in the US NFP week. Clocks will turn forward in Europe and the UK next week, but the corrective move in Great Britain Pound US Dollar is unlikely to alter its course. Concerns over soaring inflation and Ukraine tensions resurfaced and crippled Great Britain Pound US Dollar's recovery rally from 2022 lows. Great Britain Pound bulls lost conviction as the central bank's divergence returned to the fore. In the week ahead, the US non-farm payrolls, Fed's preserved PCE inflation, and BOE speak will hold relevance as the Russia-Ukraine conflict rages on. Great Britain Pound US Dollar booked the second straight weekly gain, although removed well off the three-week highs of 1.3300. After a shaky start to a new week on Monday, Great British Pound bulls fought back control and extended the previous week's rebound well into early Wednesday, testing the 1.3300 psychological hurdle. In the first half of the week, the US dollar staged a solid recovery, tracking the power rally in the Treasury yields to three-year highs, largely backed by the hawkish comments from Fed Chair Jerome Powell and his colleagues. Powell, in his prepared remarks at the National Association for Business Economics (NABE) conference, said that the central bank must move expeditiously to combat inflation, leaving doors open for 50 basis rate hikes if needed. Taking his hawkish lead, officials at the world's most powerful central bank also called out for aggressive tightening as the U.S. economy and its labor market remain healthy. In light of the hawkish pivot, the CME Fed Watch tool now shows a 68.3% probability of a 50 BPS rate hike at the May FOMC policy meeting. Amid the dollar strength, the British pound stood resilient in the face of the market optimism on the Russia-Ukraine conflict, as the Ukrainian President Volodymyr Zelensky was invited to address the NATO summit scheduled on Thursday. Further, Zelensky said they were ready to discuss commitment not to join NATO and discuss the status of Crimea and Donbass after a ceasefire. The relief rally evaporated on Wednesday after the UK inflation came in hotter than expected at 6.2% in February and its highest level in 30 years. Great Britain pound US dollar reversed sharply from multi-week highs and breached 1.3200 once again as soaring UK inflation raised concerns about the country's economic health while accentuating the BOE's dilemma. The BOE had already turned cautious at its March policy announcement due to the negative impact of higher inflation on economic activity. The monetary policy divergence between the Fed and the BOE came into play and weighed heavily on cable. Great Britain pound US dollar faces an interim resistance at 1.3250, Fibonacci 38.2% retracement of the latest downtrend. Before it can target 1.3300, Fibonacci 50% retracement, March 23rd high. A daily close above the latter could attract bulls and help the pair rise toward 1.3400, Fibonacci 61.8% retracement, 50-day SMA, 100-day SMA. On the downside, 1.3150, Fibonacci 38.2% retracement aligns as first support before the critical 1.3100 level, where the 200-week MA is located. In case sellers manage to drag Great Britain pound US dollar below 1.3100 and hold it there, 1.3000 psychological level, static level, could be seen as the next bearish target. The forecast poll shows that bulls represent half of the polled experts on the one-week view. The average price target of 1.3194, however, suggests that the British pound's gains are likely to remain limited in the near term. Lastly, we have Australian dollar, US dollar forecast. Test of October 2021 on the cards, then what? The Australian dollar-US dollar pair has advanced for a second consecutive week, reaching a fresh 2022 high of 0.7536. Despite a generally risk-averse environment, the Australian dollar found its way higher, helped by commodity prices. The Russian invasion of neighbor Ukraine triggered concerns about global supplies, sending oil and natural gas prices to multi-year highs. The dismal market mood also helped gold prices, which in turn underpinned the Aussie. Central bank imbalances did not take their toll to the pair, despite U.S. Federal Reserve Chairman Jerome Powell become more aggressive on monetary policy by hinting he will favor a 50 BPS rate hike in the upcoming May meeting. He also explained that they would likely complete plans for a balance sheet reduction by the time of the next decision. Reserve Bank of Australia Governor Philip Lowe, on the other hand, maintained the patient stance, barely indicating that a rate hike before year-end is possible. The U.S. has 6 more in the docket for 2022, according to the dot plot. However, escalating tensions in the Ukraine-Russia front boosting commodity prices would not be enough to keep the Australian dollar on the winning side for long. Shortages and supply chain issues will likely aggravate and take their toll in all major development economies. From a technical point of view, Australian dollar-US dollar is poised to extend its gains. The weekly chart shows that it continued to advance beyond its moving averages, while technical indicators offer a strong upward momentum within positive levels. The daily chart offers a similar picture, with the 20 SMA having crossed almost vertically the longer ones, all of them over 200 pips below the current level. The momentum indicator is heading firmly higher, but the RSI is stable at around 67, hinting at a possible bearish corrective movement. The immediate resistance level is in October 2021 monthly high at 0.7554, followed by the 0.7600 level. Above the latter, the pair could extend its rally towards the 0.7670 price zone. On the other hand, the corrective decline could kick in if the pair slides below the 0.7490 and approaches the 0.7400 level afterwards, where buyers should come back to maintain the bullish trend alive. The forecast poll reflects mounting speculation for Australian dollar correcting its latest rally. The pair is extended to remain sideways around 0.7500 in the near term, but the turn bearish afterwards, holding anyway about the 0.7300 mark. Those expecting the pair to retreat are around 80% of the polled experts in the monthly and quarterly views. The overview chart shows that the bulls are in full control, as moving averages head firmly higher in 3 time frame under study. Chances of a side below the 0.7000 threshold have decreased sharply, with most targets still accumulating about the 0.7200 mark. The above is the analysis of the foreign exchange market in April 2022. Thank you for watching. See you in the next month.